So the RBA surprised the market by hiking the cash rate target to 3.85%. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee and, well, aren't we all a little surprised? The RBA has hiked the cash rate there. We're now sitting at 3.85% for the target. Now, before we check out the statement from our very own governor, let's jump over here and have a look at the RBA rate tracker. Now, this is showing you, even yesterday, the market had priced in no change 100%. The 28th of April, no change 100%, increased to 3.85. The highest we have was on the 19th of April, 23%. And, well, the day before, it was 0%. So the market, at least the RBA measurement, that measured by the ASX RBA rate tracker, didn't anticipate an increase to the cash rate target, or an increase. We can see here, I asked the viewers of the channel. 55% of you said yes, they will raise the cash rate target. 42% said it'll be on hold, and 3% said they would lower it. Let's check out Trading Economics to see what they forecast. Australia hikes the cash rate. Yep, you can see here, it's heading right up there. And you know what? I updated my chart too, guys. There you go. There you go. I had to go so long without updating it. We have a look here. So the consensus and the forecast, so the consensus and the Trading Economics forecast were both hold. And they've gone hard. Okay, now the question is, did they lift that rate? Let's have a look at some of the top comments. Did they, pause and then lift to have the maximum psychological impact? So let's jump over here because, they should raise the rate, but will most likely protect the property bubble. Well, looks like they didn't. It looks like they didn't. We'll jump over, check out the statement from our governor, and then we'll go through some of your comments. So, are you surprised? Honestly, I am. I thought they might have held for another month just to see, but there you go. At its meeting today, the board decided to increase the cash rate target by 25 basis points to 3.85%. It also increased the rate paid on exchange settlement balances by 25 basis points to 3.75. Inflation in Australia has passed its peak, but at 7% is still too high, and it will be some time yet before it is back in the target range. Given the importance of returning inflation to target within a reasonable time frame, the board judged that a further increase in interest rates was warranted today. The board held interest rates steady last month to provide additional time to assess the state of the economy and the outlook. While the recent data showed a welcome decline in inflation, the central forecast remains that it takes a couple of years before inflation returns to the top of the target range. Inflation is expected to be 4.5% in 2023 and 3% in mid-25. Goods price inflation is clearly slowing due to better balance of supply and demand following the resolution of the pandemic disruptions. But services price inflation is still very high and broadly based, and the experience overseas points to upside risks. Unit labour costs are also rising briskly, with productivity growths remaining subdued. The recent Australian data also confirmed that the labour market remains very tight, with the unemployment rate at a near 50-year low. Many firms continue to experience difficulty hiring workers, although there has been some easing in labour shortages and the number of vacancies has declined a little. The board's priority remains to return inflation to target. High inflation makes life difficult for people and damages the functioning of the economy. And if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates with a larger rise in unemployment. Medium-term inflation expectations remain well anchored, and it is important that this remains the case. Today's further adjustment in interest rates will help in this regard. Wages growth has picked up in response to the tight labour market and high inflation. At the aggregate level, wages growth is still consistent with the inflation target, provided that productivity growth picks up. The board remains alert to the risk that expectations of ongoing high inflation contribute to larger increases in both prices and wages, especially given the limited spare capacity in the economy and the historically low rate of unemployment. Accordingly, it will continue to pay attention to both the evolution of labour costs and the price-setting behaviour of firms. The board is still seeking to keep the economy on an even keel as inflation returns to the 2 to 3% target range. But the path to achieving a soft landing remains a narrow one. I don't like that term. The central forecast is for the economy to continue growing, albeit at a below-trend pace. GDP is forecast to increase by 1.25% this year and around 2% over the year to mid-2025. Now, this is interesting that they're forecasting GDP to continue growing at a below-trend pace. GDP per capita growth has been below trend since the GFC. So, given the expected below-trend growth in the economy, the unemployment rate is forecast to increase gradually to be around 4.5% by mid-2025. A significant source of uncertainty continues to be the outlook for household consumption. The combination of higher interest rates, cost of living pressures, and the earlier decline in housing prices is leading to a substantial slowing in household spending. While some households have substantial savings buffers, others are experiencing a painful squeeze on their finances. There are also uncertainties regarding the global economy, which is expected to grow at a below-average rate over the next couple of years. Some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame, but that will depend upon how the economy and inflation evolve. The board will continue to pay close attention to developments in the global economy, trends in household spending, and the outlook for inflation in the labour market. The board remains resolute in its determination to return inflation to target, and will do what is necessary to achieve that. So there's your, don't listen to all the spin or even what the market's predicting. We're in charge. We'll have to see. Maybe this is so Lowe can protect his job prospects. What do you reckon? So let's jump over and check out some of the comments from you viewers. So let's have a look here. Sunrise, one of my friends who works at the airport is saying, less people are flying. Discretionary spending has slowed significantly in the last few weeks. I think the RBA will hold. We'll have to wait and see approach. Intellectual Galdi, these strange names. IG, whatever the correct thing to do is in Australia's long-term best interest, the RBA will do the opposite. Cheer out to plus 9%. Okay, Steve reckons it's not. We're heading up higher. I think they'll leave the rates on hold tomorrow. I mean, I don't get why pausing rate hikes for 1 month makes any sense at all. Well, honestly, this is going to have more of an impact because they paused for a wait and see, and the media and the market priced everything differently, and everyone's thinking, oh, okay, it's going to be okay. Oh, this is the peak. This is the peak. And now, boom, they hit us all with this rate hike. It's going to have a greater psychological impact on people. That's what economics really is, isn't it? It's psychology. The influence, nudging you, manipulating people, group and crowd behavior. That's what we're seeing here. So it might be quite smart. If they don't, eggs will be priced at $20 a dozen. Tough call. Initial plan was to hike only up to 3.5, but most of the YOY inflation only comes down in June. So I guess against popular opinion, I'll say hike 15 points. They hiked higher than that. Hold until the majority of home loans have come off fixed term into new agreements, then jack it up. No, I don't think that's going to happen. AWG's is talking about AFL cards, and I thought it was a bot. Okay. Yeah. I'm gonna delete that one because it's telling people to invest in some bullshit. You'd be surprised how much bots and scams and investment stuff all just filters through onto the channel. I've got to get all these terms to filter out. So sadly, that's why sometimes if you put a comment it may not make it through. That's why I've had to ban all links, because the bots are just crazy on this platform. You think YouTube would fix it, wouldn't you? What's real annoying is, as a content creator, they will steal my logo, put it on their page, and then post to my page. And I'll report them. I'll keep a track of the websites, of the YouTube channels. Because what they do is they just flip to a different channel. So you can find all these channels in the similar sphere of topics that you're discussing, because the bots are going to them all. And YouTube does nothing. But anyway, let's keep going. The rate should be much higher than it is, but because they've have to protect the housing bubble, they'll have to continue to, guaranteed they'll do the wrong thing. Given the rates should be double where they are, I reckon they'll hold. Yeah, well, they're not a bunch of cowards. They've done it. They've done it. Well, apparently 7% inflation is just dandy, so they'll hold. We're in stagflation, so it's too late. We're not in stagflation yet. We're not in it yet, not by a long shot. Okay, you don't have to rush out to go and turn your money into furniture or any useful thing you can buy as a store of wealth. No, money is still a reasonable store of wealth here in Australia. We're not in stagflation yet. No way. We've got a way to go. So guys, there we have it. They raised the rates, and let's have a talk about that one. So it appears that, the viewers are right. 55% of you predicted this. 55% of you were correct that they would increase the rates. The market was off. The consensus of economists were off. The articles were off. And the trading economics was also off. I suspect this was done to have a greater psychological impact than simply raise. Even if they had to raise rates last month and this month, paused, or last month and this month, I think this is going to have more of an impact. It's going to scare the shit out of a lot of people, and it'll impact their spending. That's what we'll see. What do you reckon, guys? Let me know your thoughts and opinions on this one. Thank you all for watching. Like, share, subscribe to the channel. Check out Heise BIM and Heise Does. And if you're a fan and want to support us, you can on YouTube or Patreon. Use our referral links, buy our pocket squares, or call us if you need an architect. Take care. Have a great day. I'll see you next time. Bye for now.